Hello guys, hope you all are doing good. The Ministry of Finance has recently issued a new Ministerial Decision 302 of 2024 in the context of participation exemption and foreign permanent establishment exemption. The new Ministerial Decision 302 of 2024 rescinds the earlier decision of 116 of 2023. The new decision will apply for tax periods commencing on or after 1st January 2025 and for the taxable period which have already begun before this date, the earlier version shall prevail. At the outset, the definition have been amended through the ministerial decision. Three new definitions have been added. One is in context of parent company. The second one is in the context of qualified foreign permanent establishment, which is QFPE, and third one is non-QFPE. QFPE is a foreign permanent establishment that is subject to or will be subject to tax at the rate of 9%. That is, corporate tax or similar tax applied in that another jurisdiction should be 9% or more. If it is not the case, then it will be non-QFPE. The participation exemption provisions under the corporate tax law requires you to own the asset or have an intention of holding the asset for 12 months or more. In this context, if you have acquired a new asset pursuant to a business restructuring relief under the corporate tax law, then the period of holding of the earlier asset would also have been considered. The new relief, directions continues the said relief. However, in the BRR, which is business restructuring relief, there are certain conditions relating to 2 years limitation. So the amended directions are providing certain relief in context of this as well. More clarification has been provided. Besides this, the new directions or the new MD also clarifies regarding certain aspects of interplay of qualifying group relief, which is QGR, BRR, which is business restructuring relief, and participation exemption in case of clawback provisions are triggered. Under the earlier MD, there was a point of minimum acquisition cost of AED 4 million will be considered as participating interest. However, there was a question if this point of 5% participation interest or 5% profit entitlement or 5% interest in the proceeds of liquidation, will this 4 million acquisition cost apply in that scenario as well? Now it has been clarified that if you are having investments of 4 million or more, then that 4 million will be the only test. You need not see the test of 5% profit interest or 5% interest in case of liquidation. Also, it is a new section altogether, a new clarification which has been provided, which said that for the application of asset test, you only need to make this test for a foreign entity if that foreign entity is your related party. If it is not your related party, then you need not have the asset test for that entity. In the earlier context, there was an adjustment was required in case of liquidation loss. This liquidation loss was in the context of tax losses transferred by the participation, या तो exempt tax losses or exempt dividend or any profit distribution received from participation, or income or gain from any assets which has been transferred pursuant to qualifying group relief or business restructuring relief. And also the period for this was the relevant tax period for the purpose of considering the tax loss, the relevant tax period, and the preceding tax period. The Ministerial Decision 302 has expressly clarified that the adjustment to liquidation losses should be in the form of reduction of the losses. but the scope of that tax loss has been expanded to also cover the case where the group has been utilized in case of a tax group. Also, the period of the relevant year and the preceding year whose loss was to be ignored has been expanded to include the relevant year as well as 7 preceding years. Also, as per MD 116, in the context of foreign permanent establishment exemption, to be eligible to elect for foreign PE exemption, to claim participation exemption from or following incorporation of a foreign PE, previously utilized tax losses of foreign PE must be fully offset by the taxable income earned from that foreign PE. The MD 302 has clarified the eligibility criteria to elect for foreign PE exemption to cover various cases.